Welcome class, this is ATD Level 2 Financial Accounting, August 2021 paper, which is also applicable for the CPA students, CPA foundation level students. So we'll go to question 2. This is question 2 of the August 2021 sitting. Okay, so 2A, distinguish between direct method and indirect method of cash flow statement preparation. Distinguish between direct method and indirect method of cash flow statement preparation. Now, these are two different ways that we can work out the cash flow. The cash flow is all about the movement of cash in and out of the organization, and you can either work out using the direct method or the indirect method. Now, the direct method is this method that identifies the changes, changes in receipts and payments, almost in real time. As you do your stuff, you capture them as receipts and payments, and basically you capture the cash inflows and outflows. Anything that brings money in, you capture it as bringing as an inflow. Anything that takes money out, you capture it as having taken money out, that is as an outflow. Then the indirect method, it just doesn't apply. You don't capture inflows and outflows per se as and when they occur, but instead you have to prepare the statement, the income statement. You have to prepare the income statement and then get the cash flow from the income statement. So for indirect method, we get the cash flow from the income statement, and then we start working, like going backwards, where we start with the net profit before tax, and then we possibly add or subtract changes in the non-cash movements within that particular period of time. So for the indirect method, we have first of all to have an income statement, and then we start from the net profit before tax, working backwards, trying to factor in those movements that really didn't involve money transfers, as opposed to the direct method, where we capture only the movement, the inflows and the outflows as and when the transactions take place. The other difference possibly is that the direct method is not so much used. It's not commonly used, unless if you're talking about small businesses. Small businesses might find it useful because of the few transactions that they have. Otherwise, for bigger businesses, the indirect method is preferred, and so it's commonly used. So indirect method commonly used as opposed to the direct method, which is not commonly used. And if it is used, in most cases we are talking about small organizations which don't have a lot of complications or so many transactions. Then, of course, the direct method is simple to understand, unlike the indirect method, which is not so easy to understand. But when you talk about calculation, from a calculation point of view, especially accountants who are qualified, the direct method is complex to calculate. Simple to understand, but complex to calculate. While the indirect method is not so simple to understand, but it's very easy to compute because we are simply dealing with the few items that don't involve transfer of money. Otherwise, all of them are generally accepted accounting, fall within the GAAP standards, and so any can be used, but indirect method is preferred because it's easier for computation and it applies to big organizations perfectly well. Thank you. I think those are so many differences. Just pick, if you can just distinguish them from the definition, you'll be good to go. Direct method captures receipts and payments that involve inflow and outflow as and when the transactions occur. indirect methods, you will have first of all to go through the preparation of an income statement before you can now work back in like a reverse mode, where you start from the net profit before tax, which is normally at the end of the income statement, and then you start adding, working backwards, either adding or subtracting what is not supposed to be included in the cash flow or what is supposed to be included in the cash flow. Thank you. Let's move to B. B. The following are the statements of financial statements of Pambaza Limited, a chemical manufacturing company for the year ended that. Statement of financial position. Now we have 2020 and 2019. Please download the paper just underneath. I think this paper might also be, it's a bit mutilated. We don't have the figures as they are, so I'll use my paper. Please just use your paper, download the paper just beneath to help you go through this question. So I'll go straight to the additional information, the rest of the information. What you need to remember always, I always tell my students, for the statement of financial position, you'll get 2 years, the current year and the preceding financial year, and then the income statement will only have the current year. So if you see such, like, I think it's normal. And why we have it in the financial position, the 2 different years, is to allow comparisons, especially when we talk about the differences, when we are working out the differences, to see the increment or a decrease in basically capture the movements in cash operations. So additional information: Pambaza Limited made a profit of 6,729. I'll make use of my paper here. I also urge you to make use of the paper. Just download it, then you can proceed. 6729. And then the income tax expense for the year ended, that was, so this is direct, income tax expense direct. Pambaza a profit before tax of 6729. Maybe we can just work out the income tax expense for the year ended, that first date 2020 was at 189. Let's work out this income tax expense once and for all, so that it doesn't come back to haunt us later. I think that space should be enough. That should be enough. That's a lot of space. Okay. So for the income, for the tax paid, we simply come up with a tax paid account. This is credit, this is debit, and tax paid is tax paid. You can see current tax is under liability. So we'll have balance brought down to 70. We'll simply come here, balance brought down to 70 because it's a liability, and then balance carried down, so that come the following year it will simply go to its rightful place, which is the credit side. So balance for 50, for 50, and then we have the what has been declared in the profit and loss. It has just been declared. The income tax expense for the year ended was 189. It doesn't mean that it has been paid. We are actually interested in the movement of what has actually been paid. So 189 is P&L account, 189. So from this we'll be able to get what has actually been paid. This is 459, this is 459. So here we have 9 shillings, and this is what will come in as tax paid. So that is our working one, number 1. We are done. Let's go to the next line. It is the policy of Pambaza Limited to depreciate all assets at a rate of 10% per annum on cost, with a pro rata charge in the year of acquisition and disposal. Yeah, we'll use that one when the right time comes. The cost of property, plant, and equipment was 21,870 on 1st January 2020. The purchase of new equipment occurred on 31st December 2020. And we are supposed to prepare this book in 31st December 2020. And the purchase of new equipment occurred on 31st December 2020. Okay, there's something there. Maybe we'll come back to it. Pambaza Limited disposed of a plant with a carrying value of 1560 on 1st October 2020. The original cost of this plant was 24, and the company made a loss of 60. So what you can get from this additional point number 5 is very simple. Additional point number 5, we disposed a plant with a carrying value of 1560 and its original value was 24. So original cost, let's just say cost of this item was 24. Then net book value was 1560. So depreciation is 24 minus 1560. This is 840. Is it? Yeah. 440 plus 400, 840. That is the depreciation. So depreciation is 840. And then the original cost of this plant was, and the company made a loss of 60. So of course we have loss on sale of this item. Loss on sale is how much? 60. Loss on sale is 60. So those are figures that we can pick from there. The finance cost incurred and paid in the year ended was 144, that is direct. Paid a dividend of 258, that is direct. So let's start, then we'll work out as we move on, especially on the depreciation. We will work out that one when we come to that particular point. So perhaps we might just want to leave some space for depreciation. That will be space enough for depreciation. So let's start this question. The question is on Pambaza Limited, and is a statement of cash flow or cash flow statement for the year ended. This is at first deck 2020. So we underline that, and then as usual we will start with the cash flow from operating activities as per the format. Cash flow from operating activities. I insist on your understanding. So shilling 000, you can have 3 columns for ease of working. Yeah. So then we always start with the net profit before tax. So let's go to net profit before tax. Just go back to the question, pick it. In most cases will be given. Now, in this question, we've not been given the statement, the income statement. But luckily for us, most of the information has been captured in the additional information. Like this one, we have it here. A profit before tax of 67.29. So just pick it the way it is. Profit before tax of 67.29, preferably here, so that we can get the total of the operating activities. That's what will go to the outermost column. Then once we have that, we can now say the non-cash and operating, non-cash and non-operating items. So of course depreciation will have here, if we have interest paid, if we have all those things, loss and profit, those are the things that we'll normally talk about here. So I can already single out some items here. Let's start with the ones that are very direct. Finance cost incurred 144. So this one we just less. Finance cost incurred is 144. Finance cost incurred. Now, finance cost, remember this one we had paid. So we are just returning it back. This one is a non-operating. It's really not supposed to be here. According to the format, it will come a little bit later. So that's why we are simply negating it, but we'll add it back. So generally we had reduced the profit. So what are we supposed to do? Add it back. It had reduced the profit, so we add it back. We had deducted it from the gross profit. So it reduced. It had the effect of reducing the net profit. So simply add it back, but we will remove it at the rightful time. So finance cost incurred. How much is that? 144 according to the question paper. 144. So we are adding it back. It's here. 144. Dividend has nothing to do with that. Then of course we have there's this loss. I think we had a loss somewhere. Company made a loss of 60,000. So loss on sale of asset. Loss on sale of asset. How much is that? It was 60. Now a loss we always this thing comes from here. We always say gross profit, add income and gains, less expenses and losses. This is what we do, less expense and losses. So losses we had deducted, but because we are, this is a it's actually a non-current asset, we will include it in the rightful place where it's supposed to be. That is under the investment activities, not the operating activities. So let's just we want to negate whatever it is that we did, so that we take it its rightful place, which is the investment activities. So then here the loss we had deducted, so we simply add back. We add back, and you can see now 60 loss we add back because we had deducted. Then let's see if there's anything else. Now depreciation. Depreciation is a non-cash item. There is something about depreciation here. There's a lot of work on depreciation. Let's just see. We need to understand this depreciation thing well. It is the policy of Pambaza Limited to depreciate all assets at the rate of 10% per annum on cost with a pro rata charge in the year of acquisition and disposal. The cost of property, plant and equipment was 21,870 on 1st January 2020. On 1st January 2020. So let's check 1st January 2020 here. In the question, there's a figure here I think which is missing. 17,730. There's a figure here that is missing. So 17,730. But here they are talking of, this is 31st December 2019, the value of 17,730. And then here 31st December 2020, no, 1st January 2020, 21 is 70. So 1st January 2020, 21 is 70. 1st Jan 2020, the figure is 21,870. Then 31st December 2019, the figure is 17,730. What does that mean? It means that there was an additional asset overnight. Maybe there's an asset that was bought at the very beginning of this year. There's an asset that was bought at the very beginning of this year. So that means there was an additional asset of 21,870 minus 17,730. This gives us 41, 21, 41, 40. There was an additional asset of 41, 40. Okay, but let's leave that one out. We started with it that year. So it is the policy of Pambaza Limited to depreciate all assets at the rate of 10% per annum on cost with the pro rata charge in the year of acquisition and disposal. The cost of property, plant and equipment was 21,870 1st January. The purchase of new equipment occurred on 31st December 2020. There was a new equipment that was purchased on 31st December 2020. So there was no depreciation. If it was purchased on 31st December 2020 and we are preparing the books on 31st December 2020, definitely there was no depreciation. So I guess let's just leave this one out. It doesn't apply anywhere here. So let's just work with what we have. 24 minus 1560. Because for this one it's very clear we have an accumulated depreciation of 840. And we had even worked it out here. So let's just go with that. Depreciation 840. And since it's an uncash item, we simply add it back. We had deducted. We normally less depreciation in the P&L account, so we add it back, and this will give us a figure of, I think we are done with that first part. So this will be, this will be 144 plus 60 plus 840. That gives us 1044. Good. Then we now work the operating cash flow. Operating cash flows from working capital changes. Working capital changes, we always look at 3 items. You'll always get these 3 items unless otherwise. We have inventory, inventory, accounts receivable, and accounts payable. So inventory, the figures are, I'm just looking at the question paper, look at this one of ours is quite distorted. The inventories is 5490, moved from 5490 to 6210. That is inventory. Then for accounts receivable, 3060 to 3510. So when you look at the changes, it moved actually from 5490 to 6210. That is 510 plus 210, I think is 720. But let's just work out with the calculator, it makes life easier and accurate. 6210 minus 5490. This gives us 720. 720. Then this one, the second part of it, it actually increased from 3510. It increased from 3060 to 3510. So minus 3060. This is 450. You can see this is 2019, this is 2020. So it's an increment. It's an increment. From 2019 to 2020, we increased. Now, if current assets increase, it simply, especially the inventory. If inventory is increased, it means money flowed out of the business. If accounts receivable increases, it means people are holding our money outside there. So they are treated as outflows. So we simply say increase in accounts, increase in inventory 720. We show them as outflows. Increase in inventory. Increase in inventory 720. Then increase in accounts receivable. In accounts receivable. How much was the figure? Increase in accounts receivable, the figure is 450. So 450. And these are now equivalent to outflows because this is money that is going out for us to get additional inventory, or the debtors are holding more of our cash with them. Then we have accounts payable. Accounts payable now is this is a decrease. You can see from 6750 to 6624. So we'll say 6750 minus 6624. That gives us 126. So there's a decrease in accounts payable by 126. A decrease in accounts payable from 6750 to 6624. A decrease by 126. A decrease of 126. A decrease of 126. So decrease 126. Decrease in accounts payable. Decrease in accounts payable 126. So this will be 126 minus 450 minus 720. That gives us 1044. What a coincidence. Let me repeat it again. This looks like a coincidence. Sorry. In fact, we had made a mistake here. Decrease in accounts payable. Decrease in accounts payable means that now we have paid them in it's like we paid more to the creditors. When you started the year, we were owing them much money. Now we close the year with, a reduced figure. So it means you have paid them more. So actually it's an outflow. So this one is actually an outflow. It's an outflow. A decrease in accounts payable is an outflow. We started with, look, 6750. But then we paid them quite a lot of money this year, in excess by 126. So it means that this 126 shillings more that went to them. It's like a loan which we have repaid. So it's more of like an outflow. So we will put that in brackets to signify that money left the organization. Actually, this coincidence has helped us. We were almost going the wrong direction. The good thing with this is that even if you go the wrong direction, you will still get to know. But don't allow that, because it can really eat on your time in a real exam setup, and normally you need to work with time. So this is 1296 but negative, 1296 negative. Then we go to, we need now to, so this will give us so this should be able to give us operating cash flows before interest and tax. So let's just add this. What will you have? This will be 6729 plus 1044 minus 1296. That gives us 6477. Then we say less interest paid, and the interest paid here, basically this finance cost incurred, which is now 144, and then we also less tax paid, and I think we had worked out on the tax paid. Tax paid was 9 shillings, so we simply less 9 shillings here, and all of this is money going out. So this will sum to 153, and then when you subtract that, you should be able to get the net operating cash flows. So that will be 6477 minus 153. This gives us 6324 as our net cash flows from operating activities. Then we go to the next item, cash flow from investment activities. Cash flow from investment activities. So cash flow from investment activities will basically look at the flow of just the comparisons. So the investment activities will look at, let's come back to the non-current assets. That's where we are likely to get the investment activities. So property, plant and equipment, will have everything to do with that, if we acquired or if we sold. Then I think inventories, those ones now are different things. So it means under that we only have the property, plant and equipment. We have to open an account for that, but let's look at if we have any other investment item. So there is this plant which was sold, item number 5, disposed of a plant with a carrying value of 1560. The net book value was 1560, but it was sold at a loss of 60. So it means it was sold at 1500. Its value was 1560, but it was sold at a loss of 60. So it means it was sold at 1500. So you can sell proceeds from sale of plant 1500. Proceeds from sale of plant. How much? 1500. You can have this here, proceeds from sale of plant 1500, and then now that proceeds from sale of plant, it means that money is coming in. And then now let's work out this depreciation and see how it goes. Depreciation account. Let's open a depreciation non-current asset account here and see how it goes. So the starting balance is 17,730, but because it's an asset, the balance brought down is always on. It's an asset, it's a debit balance. So 17,730 from the question, and then balance carried down will be the normal, will now be the 23,040. Check from the past paper. I think here in our question it has been distorted, but these are the figures I'm working with. Then check if we have revaluation reserve. Yeah, so revaluation 360, balance brought down is 360 on the credit side. You can see brought down 360 because it's on the found in the liabilities. So balance brought down 360, balance brought down 360, and then balance carried down will be, we go back, balance carried down will be on the balance carried down 360, 540. So 540. So balance carried down is 540. Sorry, balance carried down is 540. Then of course there was a disposal. And the disposal, we take the cost of the item that we disposed. Its value was 24. So we just pick it as it is, 24. So I think that's all that we need to have. So let's get the total here. This will be 23,040 plus 24 plus 360. That gives us 25,800. Hopefully that will be the balancing figure, 25,800. And this side will have minus 17,730 minus 540. That will give us 7,530. So we'll say this is the acquisition cost or bank account, what the bank will have paid. Because it's an asset, you can see it's on the debit side, so it's an asset. So it means the bank, if we were to have a bank account, it will be on this side, on the credit side, to show that money has left the bank. So that's how it is. So we'll simply come here and say acquisition 7,530. So asset acquisition 7,530, and that's a credit. So 1,500 minus 7,530 minus 1,500, we will have 6030, and this is a negative like that. It's 1,500 minus 7,530, which gives us 6030. So that is what we'll have in the investment activities. So let's go to cash flow from financing activities. Cash flow from financing activities. So cash flow from financing activities, we start with the share capital again. Share capital, if we have it. Share capital, there's an increase in share capital by 180. So increase in share capital 180. So you can simply say issuance of share capital 180. Because it's an increase, it means money coming in. Good. Then the next item is, let's check if we have share premium. There's also an increase of how much? 270, from 225 to 270, that is 45 shillings increment. So share premium 45 shillings. Share premium 45 shillings. Share premium 45 shillings. Then of course we have long-term loans. If there's nothing else, share capital, that one, retained earnings, that one will be captured in the dividends. With this one we've already dealt with it. Non-current liabilities, long-term loan 72. Looks like it has been distorted, so let's get back to the question paper. Long-term loan, it's from 7,200 to 6,750. So it has actually decreased. That means we've paid how much? 450. The difference is 450. So the fact that we've reduced our loan, it means money has gone outside to sort out that loan. So this means this is an outflow. So long-term liability, we talk of decrease in long-term liability. Decrease in long-term liability by 450. Decrease in long-term liability, how much? 450. So we show it like that. So 180 minus 45. 180 plus 45 minus 450. That gives us 225. So 225 credit. 225 credit. So now we are good to go. I hope we've not forgotten anything. Sorry, there's something here. Oh, there's something here. We're almost forgetting. Dividend of 258. Sorry for that. Dividend of 258. So dividend of 258. We simply say dividend paid. Dividend paid of 258. Since it is paid, we less. So let's go back again. I think we had this figure with us. So minus 258. What do we have? Negative 483. Hope now that one will be correct. I hope we've not forgotten anything else. Maybe let's just have a look. And just something before we finish this. It's always important that you go back and just have a look. Just something before we finish this. On this asset, because there's 10% here that we've been given. This 10% is supposed to work on this. But of course, this item was bought on 31st December 2020. So there's no depreciation. We can't, even if it was on pro rata charge, year of acquisition, disposal, it was bought the last day of the year. So there's nothing really to work on there. And the other way of also looking at this, because you might ask where we have used this 21870. 21870 I think even if, okay, doesn't make any difference. So 21870, I think we have it here. 21870. If we are to assume that we started with this, so it will be 21870 minus 17730, which is 41. This will give us 4140. 4140. And then we'll close the year with 23040. So what this means is that we started with 23040. Let me just work it out. For example, let me just see if there's something I'm trying to see here. NCA, credit and debit. So that we started the year with the 21870. Sorry, it's not supposed to be a credit entry, it's supposed to be a debit entry. 21870. I'm just trying to think aloud so that instead of this, we start with this. Because after all, this was the balance that we had on 1st January. So 21870. And then this will be our closing balance, 23040. And then, of course, let's factor in the revaluation. The revaluations were 360 and 240. So 360 and 240, 360 and 240. Let's also factor in what we sold. This is 2000, we sold 2400. There's something I'm working on. This is just a by the way, please. Let's get the total. So this will be 25,800. I think 25,800. So 25,800. Is it? Yeah. So 25,800 Just trying to think aloud. 25,800 minus 21,870 minus 240. So that what we get is 3690 as the acquisition, what we acquired this year. That is, if I'm going to work with this figure as opposed to the figure that we've been given in this question, which is 17,730. But even with that, the acquisition is 3690, but there's an item that we acquired. I think it's over. We acquired on the very first of January 2020, because we closed the year with this, but we started the year with 21. So there's an item we bought here for 140. So if we add that for 140 here, what do we get? This will be 30 at 18, 7830. 7830. And what do we have here? Just trying to see, this is 7530. Have I gotten this computation right? Let me just check again. Let me check again. Because it's supposed to give us the same figure. 23,040 plus 2,400 plus 360. That gives us 25,800. And then this side is 21,870 plus, oh, this is 540. This is 540. This is 540. It's actually here. So 21 actually will give us the same figure. So there's no cause of alarm. We have actually everything is plus 540. This is 22,410. So minus 25,800. That will give us 3390. So this is 3390. Then 3390 plus 4140. That gives us 7530. Good. So whichever way you want to go about it, you go about it. It is the same stuff. It is the same stuff. So what that means is that this figure, actually this was just here to really confuse us, because there was an asset that was acquired on the eve and it was valued at 44.14. The 4140 that we have here, it was acquired on the eve. And then another asset was again acquired at the very end of the year. So these are just figures to confuse us. But I think we have proved beyond doubt, so it's okay. So I doubt if there's anything else for us. Let's just finish it up. So this is from operating. Then we have this from 60/30 from investment. And then finally we have 483 from financing activities. Let's add all of them. So we'll have 6324 minus 6030 minus 483. That gives us 189. 189 negative 189. So this negative 189 will be our net cash and cash equivalent. That will be our net cash and cash equivalent, net cash and cash equivalent for the year. And then we take cash and cash equivalent, brought forward. Cash and cash equivalent brought forward is simply, we take this cash and cash equivalent at the beginning of the year. Where are they? Yeah, cash and cash equivalent, we have 504. Check if we have any overdraft. Bank overdraft 270. So it's 504 minus 270. 504 minus 270. You might want to show it. So 504 minus 270. 504 minus 270. This will give you, I think it's 234. If I'm not wrong, 234. So 234 is the balances at the beginning of the year. 189 negative is the cash movement in the course of the year. When you add the two, you are supposed to get cash and cash equivalent. Cash and cash equivalent at the end of the year, carried forward. And that will give us 234 negative 189 plus 234. That gives us 45. So what that means is that if we check on the cash and cash equivalent at the end of the year, it should be 45. So let's just check to confirm. What do we have at the beginning of the year? Cash and cash equivalent 225. At the end of the year, bank overdraft is 180. Bank overdraft is negative, so this is 225 minus 180. So that gives us 45. So it means we are actually correct. So perfect. So that's how we go about the cash flows. That's how we go about the cash flows. A very easy question. Just understand. And even if you can't understand, you can. It's the same thing. You know how to go about it, but it's the same thing. So there's no reason why you should leave this question unattended. And we mark transaction. There's absolutely no reason why you should leave this question unattended. Do it. We mark transactions, and these transactions will always come the same way. You actually just follow some of the cash flow questions that I've done here, and you realize that it's the same thing, it's just a repetition. So why? There's no good reason. Now, find it in your heart to subscribe to our channel. Subscribe, share with your friends, and the best is to come to our classes. We have online classes that we offer. Just check this site, www.globalpoint learning center, globalpointlearningcenter.com. We have our classes here, and you can buy a whole unit at very affordable price. What we sell is actually convenience and affordability. It's at an affordable price, and you can, you see the way I've explained this the same way. It's just the same way you can attend a normal class. The good thing here is that you can choose to study in the middle of the night, 12, at the comfort of your bed. You can choose to, maybe during lunch break when you are working, if you are a working class, you can choose to take 30 minutes and attend a video. It's the best thing you can have, the easiest way you can learn, and this is where the world is moving. Please subscribe to our channel and also join our classes. Visit us at www.globalpointlearningcenter.com, and you'll have a lot. You'll have a lot, and passing is a guarantee. We'll give you so many past papers. This work past papers. This is just a tip of the iceberg. We have quite a lot when you join us. Welcome. See you there. And success.